This Week in Economics from WBRN Radio and on the Bostonred Network. This episode is on the 7th of July, 2018. We'll be talking about the most recent job report. We'll get to that in just a second. A reminder here, at the Bostonred Network, we have split up our programming into a number of segments. This is the Numbers Man segment that is now beginning to be unified with the rest of the Bostonred Network. Bostonred, the political program, BR on the World, that is our international affairs program. All About Sports, a new program. We have one or two of those in the can. And the open source report, that covers open source software, hardware, library software, privacy, security, anything IT from the open source free software movement. And we have those about twice a month. We'll have one this week also. So we are now upgrading some of our programming, and you'll see that happen across all of our platforms, whether it be iHeartRadio, Stitcher, Speaker, Tumbling, you name it. We are there, and we are upgrading other things also. We'll be returning to video this summer. We, at one time, a number of our casts were on a live stream. Live stream, of course, the rates became prohibitive. But we plan to do some of those, at least simulcast them with this audio cast for, say, YouTube, etc. But on to the, as they say, the real part here. We'll first go to Berkeley and some comments from Professor Robert Rice. He is a professor there of economics and a former Treasury secretary in the Clinton administration. And some points he's making here. He's talking about the jobs numbers on Friday have little to do with Trump. The economy has gained jobs for 75 straight months before he took office. The tax cuts haven't boosted wages. In fact, hourly earnings are down for millions of workers. The deficit has expanded. Now, these are key points he is making here, and we need to be cognizant of what is going on here in real terms. And those real terms will continue to be exactly where they are. We don't anticipate a much deviation. Now, what has occurred is the tariffs have kicked in. China and the EU are in this ball game. China, of course, the majority of the tariffs that the Trump administration has levied, so to speak. Looking at one from the Chinese government, a report, 0.2% of the Chinese economy could be hurt by these, or harmed, or whatever word you want to use. That is just one of the things when you have a trade war. From the Chinese standpoint, they just have to stay focused on their economy, period. Now, yes, on the front side, they will suffer some loss in terms of their overall GMP. It could be up as much as 1%. Or 0.5%, but from 1 to 0.5%, depending. It's very difficult to handicap these particular items because, again, they tend to mushroom as they move along. So we'll just look at them as to where they are at this particular standpoint and go with those. As with any trade war, use it as a tactic for negotiation is never a very good idea. In fact, it is a bad idea because the problem is there are just too many elements that you have no idea at all as to how they will affect the overall economy. So you are sort of in a predicament where you are looking for some strategic advantage. And of course there are models out there that they use for this particular situation. They basically tell you, if you get into game theory, that the one that strikes first has an advantage and can win. Well, that is the old way of looking at it. The one that strikes first, yes, is in a better position on the front side. But as the trade war goes on, that advantage tends to deteriorate to a certain extent. In real case scenarios, say soybeans in the U.S. here would be hurt, and they would have to find an alternative marketing model, literally. Now there's some other so-called agricultural products that could find other markets. But again, that's very, very tenuous. They are not in a position at this point in time to know exactly where this particular situation is going. We'll hear from some people at Bloomberg a little later in our scenario here, and also from Reuters. But Reuters, if this is the employment situation, we have it every week when it comes out. Just let me see if I can find a different version of it. We'll deal with. We'll go to the PDF version of it. Okay. This is on for June of 2018. The total non-farm payroll increased by 213,000 jobs. The unemployment rate rose to 4%. Now, the 4% here is not something to focus on. We had 3.8% at one time and 3.9%. The Fed was forecasting that the unemployment rate would drop to 3.8, I believe, at the end of the year. 3.9, 3.8. It could be even had dropped to 3.7. But due to slack in the economy, now the problem is when you start measuring a slack, you have an official measurement, but the official measurement is usually not correct because of statistical errors that can occur there and how those numbers are reported. First of all, there's a 26-week window, and people disappear out of the forecasting models. And the long-term unemployed, particularly after 1 or 2 years, are not measured. And in the so-called gig economy, it gets to be very, very difficult to ascertain. We'll start with the household survey, as we usually do. Unemployment rate rose 0.2% to 4%, and the numbers of unemployed persons increased by, we'll say, roughly 500,000. They have it 499. That's just a figure. At 6.6 million a year early, the jobless rate was 4.3%. So in other words, you're talking about 0.3% there, and the number of unemployed persons was 7 million. Amongst working groups here, men at 3.7%, adult women also at 3.7%, Asians at 3.2%, very low unemployment. That's in June. The jobless rate for teenagers at 12.6%, for Europeans at 3.5%, for African Americans at 6.5%, and for Latinos or Hispanics 4.6%. Showed little or no change over the month. Among the unemployed numbers of losses and persons who completed temporary jobs. Now, this is always something to look at. Increased by 211,000 in June to 3.1 million. And the number of re-entries entries to the labor force rose by 204,000 to 1.1 million. Re-entries are people who previously worked but were not in the labor force prior to the beginning of their job search. So long-term unemployed, we look at us as 20. I said 26. It's 27 weeks. Increased by 289,000 in June to 1.5 million. These individuals account for 23% of the unemployed. In June, the civilian labor force grew by 601,000. The labor force participation rate edged up 0.2% over the month to 62.9%, but showed no clear trend thus far this year. The employment ratio, something we always look at 60.4%, was unchanged. The number of persons employed part-time was a little changed in June at 4.7 million. The marginally attached to the labor force, a little different from a year ago at 1.4 million persons. They have not been counted as employed because, they have not searched for work in 4 weeks preceding the survey. Now that is the survey. Amongst the marginally attached, 359,000 discouraged workers, down 155,000 from a year earlier, in other words, that was 2017. The remaining 1.1 million persons marginally attached to the labor force in June had not searched for work. The establishment survey, non-farm payroll, and not, this is something from yesteryear's non-farm as opposed to not non-farm, at 213,000 in June, and has grown by 2.4 million over the last 12 months as the number of jobs are created. Employment in professional and business services increased 50,000 in June and has risen 221,000 over the year. Manufacturing added 36,000 jobs in June. Durable goods manufacturing accounted for nearly all the increase, including job gains in fabricated metal products, 7,000 there, computers and electronic products, 5,000, primary metals at 3,000, and motor vehicles parts added jobs over the month, 12,000 after declining 8,000 in May. So basically 4,000 there. Manufacturing has added 285,000 jobs over the past year. Healthcare rose by 25,000 and has increased by 309,000 over the year. Hospitals added 11,000 jobs over the month. Employment ambulatory healthcare services, it continues to trend up at 14,000. This is 1 year healthcare, they said, with the passage of the Affordable Care Act would diminish. It has not. Construction employment continues to trend up 13,000, has increased to 282,000 over the year. Mining continues an upward trend, 5,000. The industry has added 95,000 jobs since a recent low point. That was in 2016. Retail trade lost 22,000 jobs, largely offset by a gain in May of 25,000. Employment showed little or no change over the month in many major industries: wholesale trade, transportation, warehousing, information, financial activities, leisure, hospitality, and government. The average work week for all workers was 34.5. The week edged up 1/10 to main manufacturing, that is, to 40.9. Overtime edged up 1/10 hours to 3.5 hours. Production of workers, the average there was 33.8. The hourly wage rose by 5 cents to $26.98. Over the year, earnings are up 72 cents at 2.7%. The average hourly production worker increased 4 cents to $22.62. The change in non-farm payroll employment for April was revised up from 159,000 to 175,000. Changes for May were revised from 223,000 to 244,000. Revisions. Employment gains were at 37,000. That's for both months. You'll see some of this happening and not unusual. Now for some more updates here on the 3rd of August, we'll have another one. And preliminary benchmark revisions to the establishment survey data will be released on the 22nd of August. A little bit posting here as to what is happening. And if we look at the participation rate in June, this is the in June of 2017, it was 62.8. In April, it was 62.8 of this year. And in May, 62.7. In June, it was 62.9. So it was 0.2 over the time. And the unemployment rate in June of last year, 2017, was 4.3. And in April, it was 3.9, 3.8 in May is 4. Now. So in other words, the change is 0.2%. Well, we would sort of go those in a little more detail than what you normally receive. And let's see. For 25 and older, this is years of age. The unemployment number was at 5.9. 5.9 for less than high school, 4.3 for high school, for college 3.5, and bachelor degrees at 2.1. So you can kind of see where this is going here. And 2.3. Let's see what this last column is in June. So we keep looking down here, and we tend to see where people are according to their education. And if we look at Europeans, the rate was 3.8, 3.6, 3.5, and it's still 3.5 in June. For African Americans, started a year ago at 7.1. 6.6 and 5.9. Oh, wait a minute, just a minute here. And now it's 6.5. Actually, it rose. Oops. May and June. Look back at those columns again. So there is actually a rise in the number of African Americans unemployed. Oops. Yeah, so we were at 6.5 last month. Oh, excuse me, we were at 5.9 actually. And now we're at 6.5. It was 6.6 in May and 7.1 last year. So there's been improvement here. 0.6 is the adjustment there. And let's see. Well, the Asians doesn't really matter very much. They have been, last month they were at 2.1 and now at 3.2. So those groups have all went up. For Latinos, actually went down. They were 4.9 and now it is 4.6. The number with bachelor's degrees are high at 2.3. That's back basically where it was a year ago. It was better last month at 2%. We won't quibble with this much longer, but just to illustrate where things are. when we look at last year, 1 year ago, and we look at April and May and June. So there are obviously changes there. Let's go to a little analysis here from Bloomberg. These are people speaking on what they call the U.S. economic puzzle, and it shows slack. We'll hear a little bit of this.
Neutral, and they're going to be tightening. So you look at things like the yield curve, and I think the yield curve point is very important because I think one of the reasons why term premium is so low, why the curves are so flat, is because we are nearing the real rate being met by the front end. And as we do that, and if the Fed keeps on tightening, then effectively they're tightening beyond the neutral rate, and that is where the policy mistake comes in.
So, Krishna, what do you say to people though that turn around and say that the long end of the curve is more capturing the global bond market story, that the trade story has just been another excuse to demolish the curve even flatter? If I got rid of the trade story today, just like that, magic, where would the 10-year yield be and how much steeper would the curve be? Are you saying it wouldn't be?
No, I think it may be slightly steeper, but the likelihood that it will be at 3.5% or 4%, I don't think is in the context. With or without trade. The key issue is there are structural issues facing the global economy. It's not just trade-related pressures. Inflation is not rising globally to meaningful levels. That's not something that is going away.
So let's explore this further. If you think the Federal Reserve eventually gets to a point where they need to slow down, what stops first, the balance sheet unwind or the rate hikes?
Oh, I think balance sheet unwind, in my judgment, will stop first, because that's something that they're already talking about that to some extent. Because of reserve problems or something like that. With all these things that they have created with new regulations, I don't think they have a pretty good idea as to how reserves are being used, and they're at a loss to explain the current situation.
But I guess I'm trying to explore what is the methodology to understand what should be the appropriate level of the balance sheet. How do you do the math on that? How do you know? Are we just putting our finger in the sky and saying it's 3 trillion, it's 2.5 trillion? What is it meant to be?
Realistically, the only way that you can know the size of the balance sheet is when reserve demand picks up a lot. And this is one of the reasons why there's been discussions about that, because what's happened is that there's this thing called interest on excess reserves, right? And that was set at the upper bound of the range that the Fed's trying to set the Fed funds rate. But this spring, right after they started to unwind the balance sheet, you wound up seeing the effective rate, the actual traded Fed funds rate, start to creep higher and higher and higher. And because of that, they said, oh, well, maybe this is a reserve problem. I don't think it is. I think there's other factors that are involved. But this is one of the reasons why academics and why some others are talking about stopping the unwind.
That was the end of the discussion there, and very interesting as to what the Fed will...
Talk us through how meaningful this is, because...
As to what the Fed will or will not do. And as far as the quantitative easing, when we started out, we were talking about the economy being, and in previous programs also, artificial. And what we mean by that is that the Fed, because of very tenuous conditions, brought in the quantitative easing. The number of other central banks also have quantitative easing there, and a low accommodated interest rates. The problem is with this other mix that you have this massive $1.5 trillion tax cut, and normally you don't do a tax cut, if you look at orthodox economics, unless you have a severe recession, or in the case of the 60s under President Kennedy, you had very high tax rates since World War II. So that was the reason for that. But with this, with all the accommodation that is out here, and if you recall, during the administration of Barack Obama, the conservatives were advocating the ending of quantitative easing as quickly as possible, because basically the surmise there was if they had ended quantitative easing, the economy itself would have gotten worse. Worse in terms of its performance. Now, and also in the 2016 election, from the Trump campaign, talked about the paltry job creation numbers. At roughly 200,000, the average there, so it went down to 160,000. And at the GMP numbers, that they should have been 3.5 to 3.4. Now, your problem is, and some economists are still forecasting that for Q2, the problem is if you have an aberration, say for instance, if second quarter GDP was 3.5 or 4%, you cannot sustain that in Q3 or in Q4. So that is a shock to the economy. And also on the tariff wing here, you'll have very uneven development within the American economy. The general surmise, we'll call it, is that it will only affect the smaller portions of the economy. That is factual in that rural economies and economies that state economies or regional economies that have the Cargills of the world, etc., and companies that deal internationally will feel some of the shock. But this is not a general thing across the entire economy itself, unless you get into contagion in the banking system. But this whole tenuous economic situation, the market on Friday extended because of Facebook. Roughly the price there is about $203 per share. But if you look at Google, and I haven't looked at Google in a while where they are, they're into the thousands. But you have a situation there with these tech companies, very, very tenuous. Facebook has basically co-opted as many people as they can in North America. And if the economy slows down, of course, the selling of ads slow down. And that affects these types of companies more so than other companies. So you start to have a change here, and the unemployment rate ticking up at 4%. And as the slack comes out of the economy, you'll see that uptick happen because people are re-entering. We're in July. This traditionally was a month of a transition, a particular transition in August, where people were on holidays, and at the end of August, people, particularly teenagers, etc., are getting ready to go back to school. So those people move out of the employment circle, so to speak. That has changed now because of all the part-time, gig-time jobs that are out there. But still you have labor shortages, and those will become more acute as one goes along. And energy pricing, that has also been artificially stimulated. Saudi Arabia is pumping more barrels per day, and various others are also, well, the prices are still where they are. We'll get into that part when we do the commodities. Let's go around a little bit here and over to, where we're going here. This is Bloomberg. The headline here is U.S. jobs report shows room to run as a trade war threatens gains. There's still more room to run in the U.S. labor market as a trade war is there, and they mentioned the 231,000. The data depicted a labor market that is not as right as previously thought, no doubt about that. Easing any pressure on the Federal Reserves to step up the pace of energy hikes, potentially hardening employers who have had difficulty finding skilled workers. Yet the monthly figures land the same day as the global trade war is off, $33 billion on Chinese goods. We may be heading into a trade war, but the good news is that the economy at least seems to have some good momentum. That is from Michael Farrelly. He's a chief economist at J.P. Morgan and Chase. The report showed little, if any, evidence of trade-related weakness. Too early for that. These things take a while to actually work themselves through the economy. And a number that hiring boost from the tax cuts effected in January, 7 months ago. Fed officials last month boosted the interest rate. They expect in 2018 3 or 4. They could back up and just do 3 and not 4. Very, very difficult to say there. We talked about the household survey, the participation rate at 62.9. We went over that, particularly opinion. Michael Gaspin, he's a chief economist at Barclays, and a former Fed official said that the boost in workers are coming into the market well for pushing down the unemployment rate again. Well, that's going to be more of a seesaw event. The story would be prime age women who have been at home taking care of children. Well, that always happens. Other adults who now look out and see good job opportunities move right into the ranks of the employed. There are millions of people in this type of situation. There's no doubt about that. Despite a relatively tight market, wage growth remains stuck at roughly 2%, with an average gain of 2.7%. Not much there, and that is the average. That is not the norm. The norm is obviously less. So you're looking at this particular situation, and more from Bloomberg on the participation as the Fed's big market mystery. This is by Luke Kwawa. And a company, America lags other advanced economies in the labor participation rate. Hiring data calling into question whether that is a set-in-stone reality or a trend poised to reverse. Share of U.S. population that works or looking for jobs peaked in 2000, roughly 18 years ago, then the Depression, and many economists speculate the decline will continue for demographic reasons. And they look at the 25 to 54 age rate. The trend hasn't gone unnoticed. The Federal Reserve regularly remarks on it. Chair Powell talked about it in last month in Portugal. Participation rate is a wild card, no doubt about that. If that's the case, the job market isn't as tight as the current 4% unemployment rate. So how are people talking about it? According to the Organization on Economic Cooperation and Development, the headline U.S. Participation rate stood at 73.3% in 2017. The U.K. had a similar education rate, and median population has a rate of 78.5. And doing a back-envelope calculation, the U.S. figure and UK figure, UK is 11.4 million more than the American rate. This shows, we probably put this graphic up. As to where they are now. If you look at various rates. In France, 87.7%, Japan 77.5%, Germany 78 and 78.5% for Canada, and in the UK. Advanced economies, including the U.S., are aging. There's no doubt about that. But the U.S. also lags in its peers in a prime age participation rate. Now, that, again, is a 25 to 54-year-old, ticked up to 82% in June. The Bureau of Labor Statistics reported that increase was driven by women, but both genders have been staging somewhat of a comeback since the recession. The June population participation rate ratio was sufficient to help drive unemployment higher. The jobless at 4% there. Brought in roughly 500,000 people into the market. With more slack off the labor market, it may take more time for wages to tick higher. And we've talked about this particular situation, that the employers hold the four aces, so to speak, not a very good economic term, over the workers because of decline in trade unions. And 204,000 of these were re-entrants, the biggest jump in unemployment re-entrants since 2014, and were coming in from the cold of the Depression. With more slack to work off, the labor market it may take more time for wages to tick up. And that is according to an economist at Bank of America. In a note following the report, and inflationary pressures continue in the near term. This could give the doves on the FOIC more reason to argue for slower rate hikes. The data shows that at the margins there may be more slack in the labor force than previously seen. There is always more slack in the labor force than seen, period. Let me just... U.S. trade deficit narrows to the smallest since 2016 on soybean exports. The gap decreased to 6.6 at 43.1 billion from a revised 46.1 billion. That's the Department of Commerce. They also did a report. The data will be closely watched in terms of Canada, Europe, and China. Those tariffs that went into effect, 34 billion. Report also shows a trade gap with China widening at 32 billion in May from to 32 billion in May from 30.8 billion. The overall exports increased 1.9% to 215.3 billion on soybean shipments overseas, almost doubling to 4.1 billion. Exports of civilian aircraft category tended to be volatile, rose to 1.1%. Imports rose to, 0.4%, 253.4 billion, boosted by record value of capital goods shipped from overseas. Improvements may be positive for the second quarter growth. Net exports subtracted at 0.4 tenths points from the gross national product of 2%. That is in January to March. Eliminating the influence of prices, which renders the numbers used to calculate GDP, the trade deficit shrunk to 75.3 billion, the smallest since 2017, and from 77.5 billion the prior month. Exports and imports of goods for 3/4 of America's total trade typically run a deficit there. So that is from Bloomberg. And I think looking at Reuters here, basically the same thing: labor participation rate, hourly, robust economy. Some say minutes of the Fed that was released of the June 12th and 13th meeting, upbeat there. They have to be upbeat at this stage of the game, where the economy is. A broad measure of unemployment, which includes people who want to work, etc. We already went through this. Full-time employment rose to 7.8% last month. There's some part-time from a 17-year low of, what was it? 7.6, up a little bit there. See exactly where that is going. We don't want to. America First trade policy is causing a pull over the outlook for the rest of the year into 2019. Now, 2019 strategically will be more important because 2019 you segue into an election year in 2020. Manufacturing, construction, other sectors, health resilient on trade are seen making big hits from the trade wars. Well, the trade wars, this is one of the problems we don't really have any way of doing that. Let's do the stocks here. We'll start, as we usually do, in Asia. The Nikkei at 241.15. The Hang Seng at 133.53. And I think that's the only one we'll do here. Into Europe, we'll do the FTSE at 14.48. The DAC in Germany at 31.88. In France at 4.45, excuse me. And in Spain at 33.80. These are all incidentally from Bloomberg. And we'll go up here to North America. The Dow was at 99.47. The NASDAQ at 101.96. And now at commodities. The Bloomberg Commodity Index, a plus 1.40. And the high has been, let's see, actually we get the value at 177.55. The Reuters Jeffers Index, 1.90. Brent crude down 28 cents at $77.11. Texas Intermediate was up 86 cents at $73.80. The gasoline index was down $2.08. Natural gas, let's see, up 2 cents, nothing worth talking about. And home heating oil down $1.03. Gold on the COMEX was down $3 at $1,266.80. On the spot, it was down $2.44. Don't know why that was, but at $1,255.47. Silver was down 3 cents at $16.07. Cocoa was down $17. We don't have coffee here. Corn was up $8. Do we have soybeans at all? Well, we're going to have to expand this agricultural index to get soybeans. We don't have it here from Bloomberg. Live cattle, no movement at all. We don't have our pork bellies either. cotton, one of the things that could come onto the, as they say, the proverbial chopping block, $2.49. Wheat's not mentioned here. It was up $9.55. So that is our commodities. Let's see. If we go to the BBC very, very quickly here, we don't want to leave anything out. Big headline here is China and Russia hit back at U.S. tariffs. And let's see, that was basically but as they say, the big story from the BBC. We'll look at it as we sedge out of here. China's commerce industry said it has lodged a complaint with the WTO, and Russia has announced extra duties on U.S. imports in retaliation for steel. China retaliated by a 25% tariff on 549 U.S. products, including cars, soybeans, lobsters. It's a total of $34 billion. In all, the Trump administration is threatening targeting $500 billion of Chinese products there. One of the problems with the tariffs is you keep upping the amounts and someone doesn't blink, then you are stuck with those amounts, period. From the Chinese minister here, premier, sorry about that, Mr. Liu, the trade war is never a solution. China would never start a trade war, but if any party resorts to an increased tariffs, then China will take appropriate measures. That has been their solution for a very, very long time. They've called it behavior like hoodlums. And we've seen that characterization before. Analysts from the Bank of America, Merrill Lynch, forecast only a modest escalation in the U.S.-China battle, adding, however, that we can't rule out a full-blown recession, including a trade war. They're talking about that, so. And some of the things that will affect as far as the China agricultural, industrial products, energy, and transportation. So that's basically where they are here. And we look at the Chinese daily site. And the big headline here is China will show a restraint, is their big headline. And we'll see where the restraint is. That has been their position all along here. China will not fire the first shot in implementing the trade ahead what the U.S. is doing. So that's basically it, and it'll do it for us on the 7th of July 2018 from WBRN Radio and on the Bostonred Network. The numbers man part. For those in business, make next week a productive one as we enter the second week of July. And we have normal or above normal temperatures, heat wave from Los Angeles to Boston. In many parts of Los Angeles, over 100 degrees today. Thus, the air conditioning is pumping along, as one would say, for the consumer, obviously, keep your eyes on the prize. I got a note from a woman telling me about some seniors, unfortunately, in the heat wave in various places, not turning on their air conditioning units to save money. That's a disgrace to a modern industrial economy. Talk to you next week.